Singapore's private residential market remains sluggish. Private home prices were down 4% in 2014, the first annual dip since 2008. But the negative sentiment hasn't spilled over to property stocks. The FTSE Real Estate Index is up around 14% since the beginning of last year. That contrasts with the 7% gain for the benchmark Straits Times Index.
Most of the property developers have de-risked substantially their residential exposure as a percentage of their total assets, on average about close to 10%, which means that the drop in residential prices are unlikely to hurt the balance sheet very much. Secondly, if you look at the performance of the property stocks over the past 3 market cycles, we found that most of them have stabilized at about close to 0.9 times price to book.
But investors will have to be very selective in stock picking. There is preference for property companies geared to the mass market.
The kind of per square feet ranging from 1,100 to about 1,800, the kind of range. I think those kind of pricing would be still relatively attractive. Affordability, I think when it comes to housing, is still crucial. High-end segment of in Singapore's market is badly affected by the tailwinds, I think, of all these economic activities. And if you look at the properties in Sentosa, we know that I think the prices move down easily 30%.
Analysts also like those companies that have diversified into other segments of the property market, such as commercial, retail, and hospitality.
There is a high level of recurring income, and going forward, their incomes are very visible. So they as a landlord will be able to deliver very sustained earnings growth in the next 1 to 2 years, despite uncertainty in the residential front.
These diversified companies will also be better positioned to ride on the growth in the different property segments. In the office space, there is limited supply of Grade A buildings in the Central Business District this year. New supply will come on stream in 2016, but according to JLL, office supply will once again fall below the historical take-up average of 1.5 million square feet in 2017 and 2018. Meanwhile, the retail and hospitality property sectors will likely get a boost as Singapore rolls out events to celebrate its 50th birthday. There are hopes these celebrations will draw in the visitors. And because the Singapore market is small, a further catalyst for property companies will come from venturing overseas.
If you look at the companies like CapitaLand, I think they've been successful is because I think almost 1/3 of their revenue is derived from China and from different regions. So any of the Singapore company up to a certain point in time, they do need to look into Australia, Malaysia, Thailand, and China. I would say some of these markets really offer very attractive opportunities as long as I think we can leverage on our capability in developments and ability to identify undervalued assets.
Among the property stocks, DBS likes UOL and CapitaLand.
We like the likes of UOL, which is one of our picks for the sector, and also we like CapitaLand. Essentially, we expect CapitaLand to deliver a fairly good set of numbers post the privatization of CMA, and prospects would include some of the asset divestments into some of the REITs, given where the REITs currently are trading. There will be further catalyst for the stock in the medium term.
Property developer Wang is another counter that analysts are looking at.
For property, personally, I mean, in terms of valuation-wise, definitely we are favorable of Wang. It has a very capable and strong management, and with a 6.8 P ratio, as well as a dividend yield of close to 3%.
Buying property stocks is one way to gain exposure to the real estate sector. The other way is to invest in real estate investment trusts, or REITs. REITs generated better gains for investors last year. The FTSE REIT index gained 9% in 2014. That compares with a gain of 6.5% for the FTSE Real Estate Index. The situation reversed in 2015 with the real estate index advancing more than the REIT index. REITs face headwinds going forward. This as interest rates rise in the US.
they probably need to manage the interest rate costs with the banks, and they might need to shift their durations of their debts to a longer duration to manage it, and hopefully I think they can negotiate better rate with the bank.
Now, REITs will also have to pay a 3% stamp duty if they buy properties in Singapore.
I'd put it back to a money mind viewer. If the money mind viewer wanted to purchase a stock, particular stock, like a real estate manager is looking to purchase a property, and let's say the money mind viewer had to pay brokerage of $100 to buy that stock rather than $50 to buy that stock. Potentially, your viewer would put a little bit more work into making sure it was the right stock if they had more transaction costs involved with that transaction.
The impact of the stamp duty is likely to be minimal. Instead, the extra cost prompts the REIT manager to be more careful in making any acquisition. As to which REITs to invest in, analysts say look for those with growth potential and don't focus so much on the yields.
The drive for more yield would get lesser once interest rate rise, opportunity costs rise. So the next catalyst then again for the REITs will be growth, especially if their income can grow at a rate that's faster than interest rate rising.
DBS likes Mapletree Greater China Commercial Trust and Ascenders REIT.
The ones that we like are the ones with very good earnings growth, and also in addition to that, potentially from currency tailwinds, that would be the likes of Mapletree Greater China. Earnings are based in Hong Kong dollars, so on top of a rental growth in excess of about 20% reversions, we should continue to see a lift from currency funds. So I think that is probably one of the picks that we like. Within the other space, we like Ascenders, largely due to the fact that they have a fairly large exposure in the business park space, which I think will do well in an environment where there's a lack of office supply in the CBD, and I think it will tend to overflow into the business park segment.
REITs and property companies complement each other, thus an investor can consider both investment types in their portfolio.
They do tend to move a little differently. There is a little bit of difference in their performances and their swings, particularly over the past 12 months or so. As we saw in the past 12 months, we saw real estate investment trusts lead the real estate index over the past 12 months, where it was the holding and developing companies that have really taken the lead in the year to date so far. So there is variation and a different role for these two segments to play in a portfolio that wants to have a focus on real estate.
As analysts advise, buy REITs for the stability in income flow they offer, and buy developers for the returns and capital appreciation opportunities they provide.
Up next,